Welcome back to another explainer. Okay, let's dive right into this. If you're trading the financial markets, you have probably spent just, countless hours hunting for that absolute perfect setup. But here's the really hard truth. Finding that perfect entry, that is only 20% of the battle. Seriously. Your actual survival, and more importantly, your profitability, depends almost entirely on what you do after you click buy or sell. Post-entry trade management is the real skill. So today, we're going to break down exactly how the professionals do it, especially when you're navigating volatile beasts like Bitcoin and gold. 80%. Let that sink in for a second. That is the staggering percentage of funded trading accounts that fail rapidly. And you know why? Because amateurs obsess over the perfect entry. They kind of think predicting the market is the whole game. But professional trading, it isn't about having a crystal ball. It's really about protecting your capital when the market inevitably behaves completely unpredictably. I love this quote from the prop firm app team. They hit the nail on the head, saying prop firms want to see that you won't blow up their capital. Passing the challenge is about demonstrating discipline and consistency, not trading genius. And honestly, that completely captures the essence of professional trading. It's a game of risk mitigation and psychology. It is definitely not a test of your fortune-telling abilities. You don't need to be a genius, you just need to be incredibly disciplined. All right, so here is our 90-day roadmap for today's explainer. We're looking at the trade management myth. Then, days 1 through 30, master risk. Days 31 to 60, consistent strategy. Days 61 to 90, disciplined execution. Then we'll cover active versus passive management. And finally, analyze like a pro. Let's get to it.
Section 1. The trade management myth. Why entries do not guarantee success.
All right, let's just go ahead and shatter the illusion right now that a great entry automatically equals a profitable trade. Because, you can have a beautiful textbook entry on a highly volatile asset, like, say, Bitcoin or gold. But if you don't adapt to the market's behavior as that trade actually progresses, if you hold on way too long out of sheer greed, or maybe you panic and exit early out of fear during a completely normal pullback, well, that perfect entry is literally worthless. The real magic happens when you manage the open position. This 90-day roadmap derived from Foretraders is designed to fix that exact problem. And notice the progression we've got here. You don't start by trying to make a fortune right out of the gate. Phase 1 is pure survival. Phase 2 is building a repeatable strategy. And Phase 3, well, that's all about your psychology and execution. Which brings us to Section 2, days 1 to 30, master risk. Okay, in your first month, the strictness of your survival parameters is absolutely everything. The sole objective here is simply to prove that you can protect your capital. So you risk only 0.5 to 1% per trade, period. You enforce a 2 to 3% daily loss limit so that one single bad day never turns into a blown account. Also, limiting your trading sessions to 90-minute blocks, as Earn to Trade points out, is absolutely critical. It physically prevents mental fatigue and keeps you from falling into the trap of overexposure. And honestly, crucial to this entire phase is using automated bracket orders. The very moment you enter a trade, your stop loss and take profit should be hard-coded into your system. This physically removes the temptation to drag your stop loss wider when a trade starts going against you. We've all been there, and it never ends well. So what happens when you hit a losing streak? Because you inevitably will. Nobody's immune to the market's mood swings. This is where you employ the half-risk rule. If you normally risk 1% and you hit a drawdown, you immediately cut that risk in half to 0.5%. And you keep it there until your consistency is recovered. This is literally a life-saving technique. It completely neuters the urge to revenge trade and ensures you never let a standard losing streak turn into an account-ending catastrophe. Moving right along to Section 3, days 31 to 60, consistent strategy. Once your defense is rock solid, we shift our focus to building a high-probability, repeatable execution framework. The mantra here is simplify to amplify. A lot of amateurs have charts that look like messy spaghetti, but professionals, they keep it incredibly clean. Imagine you're trading a gold chart. You want to build your confidence starting with pure price action, just identifying clear support and resistance zones. Then add just one trend indicator, like a 21-period EMA, to ensure you aren't fighting the primary tide. Finally, add one momentum indicator, like an RSI, to spot exhaustion. Remember, indicators are only there to confirm price action. They never, ever dictate it. If you need 5 different indicators to justify taking a trade, you are definitely forcing it. And before you take that shiny new strategy live, you really must backtest it until you hit these specific statistical targets. You want a Sharpe ratio greater than 1.0. That simply means your returns are actually worth the risk you're taking to get them. You want a profit factor above 1.5 and a realistic win rate of about 55% to 65%. Look, you do not need a 90% win rate to be highly profitable if your risk management is dialed in. Let the math do the heavy lifting for your confidence here. On to Section 4, Days 61 to 90, Disciplined Execution. This is the final 30 days of the roadmap. This is where you're pushing to pass an evaluation or scale your live account. And naturally, the psychological pressure is at its absolute peak right here. To survive that pressure, we rely on the 3-2-1 strategy. What is that? Well, you trade a maximum of 3 days a week, you limit yourself to 2 trades per day, and you aim for just a modest 1% profit weekly. That is it. Overtrading is the absolute enemy of the funded trader. By hyper-focusing your engagement to only your highest probability setups, you safely navigate evaluation benchmarks without exposing yourself to all that unnecessary market noise.
Section 5. Active versus passive management.
All right, now we get to the real core of handling a live trade, and we're going to utilize some great insights from market expert Joe Rabel here. So passive management, where you basically set a wide target and just let the trade run, can theoretically yield higher total returns, but it comes with brutal psychological difficulty and massive price swings. Active management, on the other hand, is how you build a smoothly ascending equity curve. Let's actually look at what this means step by step on a really volatile asset like Bitcoin. First, you enter the trade. The moment market structure confirms your direction, say it breaks a key resistance level, you step in and move your stop loss to break even. Boom, your risk is now 0. Next, as the price pushes up, you take partial profits at key levels. You lock in a 1R gain to protect those unrealized profits. You are paying yourself. Finally, you let the rest of your position run, but you dynamically trail your stop using previous structure lows or an ATR indicator. You only exit the runner when the trend shows actual weakness. Active management guarantees you never let a winning trade turn into a losing trade.
Section 6. Analyze like a pro.
The reality is, your true trading edge isn't built during the trade. It is refined after the trade is closed. The team at TraderLion lays out a really masterful post-trade routine. You must objectively grade your execution and your emotional control, not just whether the trade made money. Because look, you can have a profitable trade that was executed terribly and a losing trade that was executed perfectly. You need to analyze your top winners to see what worked, dissect your worst losers to find the leaks, and critically study missed market opportunities to train your eye. You can even use AI tools now as an objective coach to scan your trading journal. It can instantly uncover personal blind spots, like, say, realizing you mathematically lose money every single time you force a trade on a Friday afternoon.
So we've broken down the whole roadmap from mastering your daily risk to actively trailing your stops and analyzing the aftermath. Now I want you to really think about your own process for a second. Be completely honest with yourself. Do you struggle more with finding the right entry or managing your emotions and your risk after you are already in the trade? Reflect on that, apply these frameworks we talked about, and take control of your edge. Thanks so much for joining me on this explainer, and keep learning.